Well, hello everyone. Thank you for joining us today for our latest webinar. We haven't done one since November. Feels like 100 years ago, sometimes relatively, when we get into the pace of doing them on a much more frequent basis. So I'm Andrew. This is Derek. We have a full program to bring you all through today. We'll start off by touching on what's happening across the markets and the economy. We'll take a deep dive into some trends that we were able to suss out from the fourth quarter call reports. And then we'll wrap things up with a couple things that we can be doing on the ALM side to put into practice some of the observations that we have on the 30,000 foot and then the ground up perspective as well. So we'll start things off uh, with a question for you all, a similar question that we have asked many times before. Uh, where will the Fed funds range be at the end of December 2025? And we put some buckets in terms of the hard landing, the medium landing, the soft landing, and then down here I had to scroll. Is higher for longer, and it's interesting, and you'll see as the presentation goes through, we really see it in all three sections that it's the opportunity exists when actual results deviate from what is priced in or what is expected. In the first chart that we'll see in a few minutes in section one, really speaks to that in terms of the idea that projections and $2 will get you a cup of coffee, as the old saying goes. But there are things that we can do from a global balance sheet and risk management perspective that can put us in good shape. So we'll give it just a little bit more time here to let some of the answers continue to flow in. And the early results, I don't know if you all can see them, we can, is kind of in line with what our expectations were. But Stacy, if you want to wrap this up, then we can move on here. So we can see the results here. So about 60% of people thought higher for longer is where we're going to be at the end of this year. Not too terribly surprising. That is in line with what market expectations are. And we didn't do this, but anecdotally, we could go back and look at the previous instances where we asked this question and what the percentages were. I really do not believe that they were this skewed towards the higher for longer. So this has been reactionary to what the environment has given us over the last couple months.
Yeah, I think even since our last webinar, there's been a lot of change in the environment too. So that alone has changed this answer from last time. So definitely interesting to see.
I thought you were going to say there's been change since we finalized the webinar slides 2 days ago.
That too.
Sometimes that seems to be the case. So before we jump into section one, we'll get to talking about inflation and regional and national economies. But one thing that our team was able to suss out is looking at the CPI index and all the components that go into it, and taking a closer to home look and seeing how some of the products where the New England states are the leaders nationally, in some cases globally, how those prices are doing. And we spent an awful lot of time with the color coding and the markings to make sure that they were consistent with what's going on. So you can see the blueberries and the cranberries down at the bottom exhibiting an awful lot of price stability over the last 12 years. Ice cream stable, popped up in 21, 22, and has plateaued. And you can see the lobster, the volatility in lobster prices. Is interest rates have nothing on lobster volatility, but really the reason that I wanted to put this through, you can see on the subheader, and I can't take credit, we give this to Tyler for there, but the phrase crustacean inflation, we've just had to find a way to get this into the presentation because I think that's awfully poetic. So inflation and lobsters have been leading the way, but really everything else closer to home, less so. So let's jump into section one and let's talk a little bit about what's happening in the markets and the economy. And I teased this during the poll section. And many of you are familiar with this. Maybe in a version close to this, you often see this referred to as the spaghetti chart, and where we're looking at the actual path of what we've experienced with the overnight Fed funds rate, and then also what the expectations were at various points in time. Those are those more subtle gray lines. So we're not looking at futures pricing or forward rates that are inferred by what is built into the yield curve. We're looking at the dot plot, the summary of economic projections that the Federal Reserve governors do on a quarterly basis, and what their expectation for future short-term rates are going to be. And you can see when rates were rising, they were significantly underestimating the likelihood or the magnitude of rate hikes that were coming to be. We all know that story. We lived it and breathed it with what happened in short-term interest rates in 22 and in 23. But then as we hit the top of rates, the expectation shifted to now we weren't underestimating the potential hikes. We were overestimating the aggressiveness and the magnitude of the other side of the coin when interest rates were going to be going down. And we had that period of plateau, I think it was about 18 months or so, where rates held high, and versus that inverted V curve or shape that many were forecasting, that as fast as we came up, we were going to go down faster as well. And that really hasn't proven to be the case. And we can see highlighted in with the blue dots, that's where we are most recently here. And the big thing that jumps out is that the slope, the expectation is much more modest, right? It's not as steep, aggressively up or down as where it has been. And talking earlier, a common theme, and we'll see this with balance sheet tactics, is the opportunity exists when you do something that's not priced in. So when there's expectation for stability and low volatility, then the opportunity is going to be for things opposite that. And we can't underestimate the table on the right-hand side. I think this is the biggest takeaway. And it's been transparent and it's been right in front of our faces. And I'd have to go back and look at the transcripts, but I think we may have talked about this a time or two in past webinars. We talk about it a lot, so maybe we did, maybe we didn't. But you can see the gradual progression of the long run projection in terms of the Fed funds rate, the short-term rate. And there's a lot of things that go into that. And it used to be 2% target, 2% target, and then the semantics of it said a 2 to 3% range. So we all kind of ballpark that to be 2.5, right? That's between 2 and 3. And now here we sit is right at 3%. So we think about where rates may ultimately land, and really they only land in projections and economists forecast. We know that really things don't go in a too straight line all the time. But I think the important thing to focus on and take away when we talk about short-term rates, and I know I've said this before in public and one-on-one conversations, the last 2 times interest rates went down, it was an existential 100-year storm type of situation. They went down to 0%. That always doesn't have to be the case. And we see that with how the economy has slowed down, held in, and the pace of rate cuts have slowed down. And even with many of you all's expectation that we might only see 1 or 2 more cuts.
Yeah, so let's take a look at the Treasury yield curve and see how that's been affected. Even since the last time we met back in November, we've had a significant flattening of the curve. So our pivot point is right about the 2-year tenor. And what we're seeing is that the short end's falling down due to the Fed cuts, to be expected, moving in line with those cuts. But the long end of the curve is increasing slightly. So where we went from inversion, we're now to a flat to positive curve. There is some inversion up to the 1-year mark, but it's very, very small. And I know the graph is showing a very positively sloped curve here, especially on the long end, but it's a small spread. There's really not much difference between the short end and the long end. So it's definitely a different environment from what we've been used to. And I think that's one of the key takeaways too, is that it is a different environment now, and that can change how we invest and how we're using funding. And some of that we'll get into later as well. So to that point, let's take a look at how the steepness has changed over time. And so we're looking at the last essentially year here, and broken the curve down into three different pieces. So your light blue line, that's the short end. That's essentially where the Fed's moving, where the short-term rate's doing. Then we're getting to our middles with the green line, the 6 months to the 2-year spread, and we have the longer term, 2 to 5 year. That's looking more at your assets, where long-term funding looks like. So as you can see, once the Fed made their cut in September, that rate came right back up and the curve flattened significantly. And over the last 2 months, there has been a very small slope across all three segments of the curve. So it's quite indicative of rates staying flat, probably that soft landing, or even the higher for longer. The point is rates aren't moving quickly, and it seems like the short end has made its move once the Fed made that cut.
And I'll just add one point to your comments, and you said something very important. You said the parts of the curve, and I would add some further detail. That I'd say the parts of the curve that matter to depositories. One of the things, and I know this opinion is shared by others, looking at the 210 steepness is a fun graphic for CNBC. I don't know how applicable it is to managing a community depository balance sheet. So when you look at the stratification of inside of 5 years, I think those are the things that can really tell us where the opportunity set is changing, for better or for worse.
Definitely. So we've talked about the curve a little bit. So let's take a look at some of the spreads. Mortgage spreads are definitely on the tighter side right now compared to 2024, but there's still a lot of run room there. It's outperforming from treasuries, that treasury bill movement. So I think with the mortgage rates, you always have the pay down risk, but we're at a decent rate right now where you can possibly fund it shorter and still be in decent shape if that does happen. So it'd be interesting to see how these spreads move throughout the year, and how tight that becomes.
You mentioned the prepayment risk, but with any risk, it's are we getting compensated for that risk? So that really is the takeaway when you look at the nominal level of rates as well as the magnitude of how wide spreads are. So let's shift back more towards the economic side for a while and look at the unemployment rate. Very simple. The unemployment rate and the inflation rate are the two things that the Fed is caring about, so we're going to care about it. So we can look at the top level, national unemployment rate, and part of why there was so much momentum for rate cuts and aggressive rate cuts over the last 2 years was that rate was starting to tick up. So you can see in about the early part of 2023, we started to see a rise in the national unemployment rate. And now I would caution a couple of things here. Is one, it was occurring off of a very, very low rate. That 3.4 rate from a national unemployment rate is very, very low historically. And when you do start to see upticks in unemployment rate, and I think it was, if not the last webinar, the two webinars before, we looked at going back 50, 70 years, I think it was. And it didn't take much of a rise in the unemployment rate for the Fed to feel compelled to act, and in many cases act aggressively. But when you see at the beginning of a cycle, and this was a trend that we sussed out looking at credit trends in bank and credit union loan portfolios, is that there may be some early movements, but it's on the most at-risk segments. So here in New England, things we've been talking about this for a while. The economy is very robust, diversified, and strong. So when you look at the unemployment rate here across our 6-state footprint, there wasn't really much to worry about. The northern New England states in particular are extremely low unemployment rates. So if you go from 1.5 to 1.7, okay, wonderful. It went up by 0.2%. There's other states who would trade in a nanosecond. But Rhode Island and Connecticut have spent some time above the national limit, but look at Connecticut in particular. The unemployment rate has come down by about 1%, more than that actually, since 2024. So that is indicative of good things happening in the economy. But I think that it's not a coincidence also that we have seen a plateau since the middle of 2024 in the national unemployment rate. And that dovetails with that shift in sentiment from the Fed in terms of we don't need to cut rates as much as thought we did when the unemployment rate was at risk and the labor market was very clearly softening. So, let's take another look here at the labor market, and we'll look at the quit, layoff, and hiring rates because that's an interesting data point that we can look at. Uh, as many of us have done many times over the last 5 years, we strip out the 2020 data because it just completely blows up the scaling of the charts, and it was as dull an animal. We could put that over to the side there. So that's why there's those gaps in the charts there. But there's some mixed signals here, in that this has been a very odd economic boom and recovery because you've seen the hiring rate and the quit rate continue to ratchet down ever since rates started rising. So I think some part of it was consumers and individuals being very cautious about the prospects for the booming economy. It wasn't necessarily a pedal to the metal situation. There haven't been really many meaningful ticks up in the layoff rate, so that is good. But I think maybe the other part about the quit and the hiring rate not going higher as the economy is quote unquote doing better is that it's a function of cautiousness and conservatism coming out of COVID. And there's probably still an inflation component as well, is that businesses and individuals found out how to do more with less. And in terms of growing their business and expanding and taking risk, it doesn't necessarily involve going out and hiring 20 people. Maybe it's technological investments. Maybe it's facilities, whatever the case specific to the business. But in terms of employing people, maybe some of those historical relationships have broken down a little bit. Inflation, the other key component of the Fed's economic areas of emphasis. And we'll pat ourselves a little bit on the back here because we've been saying derivations of persistently high inflation, sticky inflation, for a while. I won't get up on my soapbox about the methodology of looking at the 1 year-over-year percentage change and all that goes into that. But I'll throw out this visual is in a way an economics Rorschach test, and you see what you want to see, because you can say that when we look at these underlying inflation measures that the Federal Reserve Bank of Atlanta puts together, that there was drops in all the components from December of 2023 to the most recent one in December of 2024. So hey, that's a good thing, inflation coming down. But you can see those dark blue dots. That is the target based on the core PCE, the Fed's favorite inflation measure. So that's where each one of those individual 7 metrics would need to be to get the Fed where they need to be. There's still an awful lot of room. Again, put aside that other asterisk component to how these things are calculated. So this aligns with the hawkishness. This aligns with the change in the expectations in that inflation, whether we're looking at some of the more volatile components or some of the more stable components. Prices are just high, and it's not just eggs. So let's jump into section 2. Let's take a look at what's happening across the balance sheets. So bad news about prices and eggs aside, let's start off with some good news. And net interest margins are improving wholesale pretty much across the board. So you had about 3/4 of members were able to see margin expansion in the most recent quarter. That's fantastic news. And you can see by the shading in the bars, the banks versus the credit unions. The asterisk, again, to the good news is that look at what the median NIM was for banks versus credit unions. banks in the mid 2% range. So banks really got beat up a lot. I'm not telling any bankers who something that they don't know. So while we're seeing the improvements and the bottoming and the trend up, hopefully, there's still a ways to go, probably to get us back to the levels of profitability and even risk management that we care to have. And we'll tease it. It'll come up a couple times as we move through here. What's happening with the shape of the yield curve is going to help accelerate some of these positive trends. So the natural question is, what is driving this improvement in net interest margin? Is it the asset side or is it the liability side? And the answer is both, and it depends. So when we talk about credit unions, the bigger driver has been on the repricing of the loan book. And you can see on the left-hand side, yields continue to ratchet up significantly higher. We'll get back to banks in a second. But on the funding side, there was a little bit of a tick up in funding cost for credit unions. But again, it's first world problems here, where your cost of funds went from 164 to 166 when the marginal rate is into the fours and used to be in the fives. So, and we've talked about this. Credit unions at large have done a spectacular job of maintaining deposit balances and even having some deposit rate discipline in there as well. But it was really the asset side that was the driver for credit unions. For banks, it was different. It was the cost and funds improvement. And again, here's a theme that we'll talk about in a couple different areas, that it was the repricing of what was happening. If you had a 5% rate, you feel compelled to be uber competitive. And when the Fed cut in September, if it was a money market account, we were at an event with a handful of bankers, is at a golf event, and I think one gentleman stopped, CFO stopped in his backswing to send an email to say lower the rates on the money market accounts because there was that eagerness with rates coming down. So continuing with this theme of questions, is I want to see, okay, for those who had improvements in NIM and had improvements on the funding side of the balance sheet, was there a particular characteristic that was shared? And so I wanted to look at the relationship between those who had a heavy reliance on CDs in terms of the total deposit book, and that number has really been growing for everybody. I want to see if there was a relationship between how reliant you were or are on term deposits and the quarter-over-quarter change in the cost of interest-bearing deposits. Not the level, but the change. And we really didn't see a relationship between those two factors. There's certainly, it's not pictured here, but there absolutely is a relationship between those who have higher CD balances and those who don't. So what is the takeaway here? Is that we talk about the changing of the money markets right there from the side of the golf course. When you think about the 1-year treasury rate was north of 5% up until about July of last year. So even though we're now in a much better place nominal rate wise, we forget that the rate that we had to be out there in order to bring in deposits was north of 5 not too long ago. So it takes some time for that funding to cycle through. If you did a 11-month CD in July right at the top, you still have a couple more months before you can really ratchet that rate down as the CD comes up for renewal. So the takeaway is, I think if we run this version of the chart in the next quarter and the quarter after that, we will see a growing relationship. And those who are more CD reliant will have that it's like putting the extra espresso shot in your Starbucks. So for those folks with the CDs, they will see some significant improvements, and it'll be the reverse, because if we do only get one more cut, those folks who were leading with the money market products, they were able to, if they wanted to, get 100% beta and lower those rates by 100 basis points. It was less so for those who were reliant on the CD product.
So that kind of segues us into our investment yield conversation. I think we bring this up every time. There's been lots of movement in it, but it's an important piece of our members' balance sheets. So when deposits were plentiful and there was a lot of cash to go around, especially during the pandemic, all that went into those 1% bonds. Over time, we've seen the yields improving, and I think we show this chart every time just to show that improvement. But we can see is that now probably 50% of 50% of credit unions and about 2% of banks are over that 3.5% threshold. So really good news, but a couple different factors influencing this is that the credit unions historically have had more cash, so you get more opportunity to invest as the rates have gone higher. So all those new rates are coming in at the higher amount, whereas banks have been a little bit more sticky. And then in the credit union space, as Andrew was mentioning, there's been more deposit growth, and you've been able to hold on to deposits a little bit stronger, giving you more liquidity to get into the investment portfolio. So I'd expect if rates continue this way, those 1% will start rolling off. Probably won't see the pay downs there, but you'll get the stream of income, and it's a good way to redeploy into these higher asset rates.
Yeah, and we spared everybody the putting in the unrealized loss chart in here, but with the backup in the yield curve that we talked about, really across the board, there were some weakening from September to December, and I don't think it quite hit the peak declines that we saw right out of the gate in 21 and 22, and that's a function of fixed income securities get shorter and shorter. They approach the maturity date. So all else equal, 4.5 in 2024 is not the same as 4.5 market rate in 2021. But so it really is a battle between how quickly you can reprice those slow assets, those low yielding assets that you have on the books.
Yeah, and I think one of the things that we should kind of touch on too is when the rates were going lower right before the Fed hike, there were definitely more talks about taking that unrealized loss since it was a little more beneficial. But since those hikes have happened, the environment has changed quite a bit. So talking less about that and more about how to reinvest what's coming in the future. So with all our members, there's a give and a take between the loan and deposit relationship. At times, we see the loan portfolio driving growth, yet at other times we'll see the deposit book driving the growth as well. So what we've seen over the last quarter or so is that the amount of deposits is increasing for members, whereas the loan growth is kind of stalling compared to that deposit growth. Interesting dynamic happening in terms of the liquidity aspect of each of our members. So taking a look at this relationship kind of gives us an idea of where our members are heading, what that profile will start looking like as we're moving forward. And to that point, we wanted to take a look at the loan growth within their portfolios. So we know loan growth is somewhat down compared to deposits, but how's the remixing happening? And there's a couple different factors at play, but what we see for banks is that our multifamily is increasing. Could be a cause of both the housing affordability around here and the inventory. So supply is low, but multifamily is a spot of growth. It also has a decent credit profile too. So moving into kind of the unknown and the uneasiness about what the future holds, that credit profile can be something to go to sleep with at night with and give us some comfort. On the credit union side, we're seeing new autos go down quite a bit. It looks like there's quite a bit of remixing going there towards the commercial side. And same idea, there's a lot of more credit opportunities there in terms of bettering that credit profile. So it looks like that's going to continue remixing, and we'll see in a couple quarters where we stand with that.
So keeping on the topic of loan growth, let's lift it back up to a more of a 30,000 foot as opposed to looking at the individual sectors. And let's bucket members into who just simply had positive loan growth in the quarter, who was able to clear 5%, and who was able to fortunately clear 10%. And a couple interesting things come out when we look at the data. Now we can clearly see that there's more and more members who are not growing loans quarter over quarter, but that's okay because we've had a exceptional period of loan growth, and it's occurred in an inverted yield curve. It's in a very competitive market in terms of spreads, uh, and it's also come on the heels of forced leverage through all those deposits that came in 2020 and 2021. So we were growing loans when we had a capital ratio that was probably stretched a little bit more than where we would have otherwise got to with the normal course of business, retained earnings, and the like. But what's interesting is that for all three of the buckets, positive, +5, and +10, for credit unions, it's really ratcheting down across the board. So things are slowing. Derek talked about the auto loan growth, the new auto loan growth or negative growth. But what's interesting on the banks is we're seeing an uptick in those who are greater than 10%. So I think what's interesting there is, and we talked a lot about niches and knowing what business and are you trying to be everything to everybody, or are we focusing on certain sectors? And I think that is becoming that much more apparent and that much more valuable in this current environment. That globally, not globally like the world, but globally just broadly, loan growth is slowing down. But that doesn't mean for you it has to slow down. If you've identified opportunities and you can manage the risk accordingly, and again, that's the edge being a community bank or credit union, your ability to underwrite your credits and the businesses and the individuals that you want to be in. So when we look at the some more positive signs on bank loan growth relative to credit union growth, I think that tells us that the corporate and the commercial landscape is maybe that the prospects are looking a little stronger than maybe the individual or the consumer side of the house. So let's shift from loans to deposits and talk about some trends here that we're seeing in deposit mix. And this is, I think this is going to be one of the big takeaways here for what's going to happen in 2025, that we are seeing some trends that everybody probably enjoys very much. We are seeing less and less come into CDs and term deposits and more into non-interest bearing. And so the majority of credit unions grew share drafts last quarter, which is fantastic. And non-interest bearing for banks, I'll admit that this surprised me, even though I should know this and I look at this data, that just missed by a couple basis points the third consecutive quarter where more members than not grew non-interest bearing accounts. And so we talk about the mark to market of unrealized losses on the bonds. What's the mark to market on a 0% checking account or share draft? And how valuable is that in a world where you could buy 5% investments or 6% and 7% loans? The answer is very, very valuable. So that we're seeing growth, as Derek outlined, more deposits are coming in than loans. So that's top line, that's good. But the mix is occurring. The one component that we haven't talked about is price and rate. We'll get to that in a second. But top level and the mix, good things are happening on deposits. So talk about credit and all this talk about rate risk and liquidity risk. And I saw a bank CEO last week, and we knowingly shook our heads about this and said all this focus about rate risk and liquidity risk. And I just hope we all don't collectively lose sight of credit risk. And when we looked at the various sectors that have contributed to non-performing loans, it's been non-owner occupied CRE that has contributed about half of that, and that number had been increasing up until last quarter. And interestingly, what we saw, the groups that had the largest increase in NPLs as a percentage of the loan book was 1 to 4 family and C&I, two groups that were doing pretty well. And towards the bottom end of the range. So maybe that is similar to what we talked about with the unemployment rate, where early on you get the usual suspects of who would be ticking up in a certain metric. But when the cycle starts to get a little mature, that's when you see everybody more or less get impacted by those dynamics. We'll see. Credit union data a little bit different in terms of the way we can slice and dice this. But it's interesting is that the what you think might be the usual suspect, the unsecured personal consumer loans, were a little less than half. I would have guessed it would be more than that relative to the 1 to 4 family and the autos. And CRE is a much smaller component of the credit union balance sheet in general. But by nature, it does lend itself towards some more bumps in the road relative to autos and resi. So you can see that component there that is generally outsized versus what the balance sheet is. But on a dollar basis, it's still pretty small. And the stock price, so we put together an index of all our publicly traded bank members and put it into nice one number index to 100. So we can look at it in that regards. And I say this all the time, if you're a credit union or a mutual, this is still valuable information because you get to see what the market thinks of the prospects for the industry. And we're sitting like Family Feud style and say, what are the things that we're rooting for to have positive performance for a bank balance sheet? We may say a stable economy, we may say lower short-term rates, and we may say a steeper yield curve. Well, we've gotten all three of those things have happened or been happening over the last year. And you can see really since September as well. And that coincides with the change in the shape of the yield curve, right? Short-term rates down, intermediate rates up. And it's been a good thing for bank stocks. And, the last part of that is valuations as measured by price to tangible book value were very, very, very low. So you get the macro tourists in the equity investing world who say, well, they're cheap. Banks are cheap enough that they're worth a bet as well. Improving outlook for the bank industry in general, at least as it pertains to the capital markets. And we see that with a lot of the M&A activity that has been ramping up over the last few months as well. And then we probably would expect to consider to see. So let's wrap things up in section 3, talk about some balance sheet strategies. We've talked about how call report and balance sheet data has changed. We talked about how economic and markets have changed, yield curves have changed. So the questions we should be asking and the tactics that we should be considering, not necessarily doing, but at least considering, should be changing as well. So we've teased this a little bit, but on the lending side, it's the shape of the yield curve is our friend once again. And it's ironic that it's flat, but it feels like a 500 basis point sloped yield curve because we were in an inverted yield curve for so long. But the thing that I keep asking on the lending side is, given how tight liquidity has been, are spreads where they need to be? Especially if you think we're in the later innings of the credit cycle here. That's the TBD. Investments. It's a challenge. We have the recent history and the pain that was caused by the investment book, and we'll get to it in a few slides, but the opportunity is there. The rates are high, the spreads are narrow. The spreads are wide. There's opportunity to smooth out some of the exposures on the current and the future balance sheet. And on the deposit side, we talked about the growth in the mix. The rate, while it's come down because short-term interest rates have come down, we can't lose sight of the focus that we are spread managers, and it's the spread. And there's some marginal cost of funds components, and we'll talk about that a little bit as well. So we have a couple things, at least on the wholesale funding side, that as always, us, these things don't exist in a bubble. No one goes to a cocktail party and says, I have the best Home Loan Bank Boston advanced portfolio around. It's about doing what's right for the broader balance sheet. So we got 5 ideas. We'll hop across them. There should be something for everybody here, more or less.
Sure. So the first one we'll get into is the short-term cash management. as we've mentioned throughout the whole webinar, there's a lot of uncertainty for the future, what's going to happen to rates, what's going on in the economy. So we've seen the urge to stay short with funding. So two different ways to do that. You have the overnight funding, or you can go a little bit longer, fund through the week. As everyone knows, you need to buy activity stock, but it comes with a dividend, and that is a benefit when it comes to the overall funding cost. So in these examples, if you fund overnight, you get about 3% for the stock purchase. When you're looking at the dividend, and we just announced that it's what was it, about 330 over the 90-day SOFR average.
300 over SOFR.
300 over SOFR average. Comes out to about a 15.6 basis point benefit. So your overnight funding there is 4.4%. However, when you move out of overnight into a longer term, the stock is 4%, and then that changes the dividend benefit for you. So if you're doing a 1 week classic, you're at 454, you factor in that dividend payment, comes down 22.9 basis points, then you're looking at an all-in rate of 431. So you're funding for the same time, you're getting the same benefit, but that dividend is working harder for you and you're getting a better all-in benefit. So something to look at as you're trying to fund shorter. You're not going too far out on the curve, but that dividend play can actually make a big difference in terms of your overall funding rate.
Yeah, and to the point, this is not like 6 months ago when the 5-year rate was lower than IORB, and you could say, well, you can fund out longer and save money right away.
Yeah.
Obviously, it's not quite the leap of faith going out to 1 week versus rolling an expected rolling of funds on an overnight basis for the duration of 1 week.
Yep. So the other thing we can look at is some of the floating rate advances that we have. These are actually two of my favorite I'm most interested in. You have the SOFR, the callable SOFR, and the discount note auction advance. So we won't get into all of the nitty-gritty details. If you have questions, obviously, feel free to call us and we can walk through all of it. But some of the key points here is that it's going to be floating rate. So repricing as the market reprices. On the discount note, you can reprice every 4 or 13 weeks, depending on which one you choose. But you also have the ability to call that. The option sits with the member. So say your deposits are coming in faster than you thought, there's asset pay down, loans are prepaying, you have more liquidity than you thought you would in a couple of months. You have the ability to give that funding back with no prepay penalty. So it's a very valuable option there. And with the rates, it's going to move with the market. So if there is another cut coming from the Fed, you'll see that change in rate and we won't get stuck at a higher rate. Additionally, if the market goes up, we'll see that as well, but you still have the option to call. So this is very flexible funding, and I think it's a great way to use an advance from Home Loan Bank, just in terms of your funding needs.
It's a great point, and I'll point back to January of last year when 6 or 7 rate cuts were priced in, and one of the ideas some of you may remember, we were pounding the table. I know our relationship manager, we're sick of hearing it from us, say there's value. The curve is pricing in 6 or 7 cuts, and the way that yield curves and math and fixed income math works is that it's priced in. So now it's not priced in. So when you look at these 2 floating rate advances, they are a basis point or 2 cheaper than where the fixed rate alternative is. But as Derek alluded to, you get the benefit of if rate cuts surprise to the downside, then you're going to benefit by the automatic repricing. And the call option gives you the flexibility that forget the interest rate component. You can just give the funding back if you don't need it anymore, which is something that we're probably all rooting for given how stretched liquidity has been over the last couple months, years. So rate mitigation with flexibility. If you have structural liability sensitivity and the NEV test for credit unions or EVE is bumping up against metrics or otherwise not in a place where you would love it to be, then this is a solution to help you get there. So when we think about mitigating or reducing interest rate risk, very simple: shorten assets, lengthen liabilities. We'll get to the asset side in a second. So if we want to extend out the curve with a fixed rate, there's trade-offs to that. So we can do that with a long-term classic. We could do it, for example, a 10-year structure, and that's going to help us a lot when we model out the plus 300 basis point rate shocks. But we may not like that 494 rate till the end of time, and we may not need wholesale funding for the duration there. It helps address the problem today, the NEV-EVE issue today, but the future doesn't give us the flexibility. The HOB option advance, the puttable advance, it's a 10-year structure. The rate's better, but you don't have the flexibility. You don't have the cash flow control that you would. If we talk about the 3 C's of extending funding here, you don't have the cash flow control because you're selling the option to lower the rate. So it doesn't give you that same benefit in the rate shock scenarios. But the member option does, because as the name tells us, you control the option. Now, everyone likes the idea of paying for options. Oh, excuse me. Everyone likes the idea of what the options give them, but not the idea of paying for them. So it is more expensive than the bullet and the HOB option alternative. But let's look at the key points here. We extend the funding today and get that benefit. But then we have the flexibility in the case of if we do a 10-year maturity with a 1-year lockout, we can give the fund back. We're not locked into the 10-year term like we are with the classic. And now I'll come back to the shortening asset side. When you sell bonds at a loss, that gets you more or less to the same place when you extend funding, right? You sell 7-year bonds or put on a 7-year funding. Mathematically, it should be the same, except for the selling bonds at a loss destroys capital and it impacts earnings. So that dynamic isn't as play. There's the incremental cost versus what the borrowing otherwise may have been. And then really the way to think about it is compare the rate on the member option versus the 1-year classic advance, and you suss it out. So you can lose 15% on the bond loss or pay an incremental 100 basis points over here and have that flow through earnings incrementally across multiple quarters and not just one big hit. Again, for earnings is one thing, but it's the capital that is so precious that we should be safeguarding right now. But I think if you have liability sensitivity and even NEV issues, then this should be a tire that is getting kicked. So we talked about deposit pricing and all the variables there. And Tyler, our newest team member, put up a case study on our website going through the marginal cost of funds approach. And so we'll talk about the idea that the clearing rate used to be north of 5. Now it's closer to 4, maybe even below. Some folks have told us that's fantastic, but really have to think about in terms of spreads. And cannibalization is still an issue because there are still sleepy depositors. There are still people at different rates. So we can't lose sight of the fact that even with some modest assumptions, only 33% cannibalization of a particular bucket, you still get to that 5% marginal cost of funds. So we have some tools and resources where we can run some scenarios on the marginal cost of funds. So reach out if it's something that you're grappling and debating with. We can help assist in that regard. So strengthening the future balance sheet, that is wonderfully generic of sure, who wouldn't love to do that? But this is, more specific to the idea of investment leverage. And we've talked about it 3, 4, 5 times in that the shape of the yield curve is our friend right now relative to where it's been. And that it behooves us to look at opportunities that are attractive given that environment. So here's 25 years worth of data looking at where intermediate yield curve rates are, as well as the slope of the curve between 1 and 5 year. And that serves as a proxy for what our spread would be if and when we fund. And the good thing is with a flat yield curve, we don't need the slope of the yield curve to do the heavy lifting for us. And remember, when the curve is sloped, it's not a free lunch. it means that short-term rates are going to expected to be going up. So there's always that risk. It's the opposite of what we deal with on the inverted side. However, when the curve is flat like it is right now, the opportunity is that you can let the asset spread do the bulk of the work, right? The plus 100 in the mortgage in the MBS security. So if you're thinking about where you can get the mortgage-backed security yield, where you can fund if you have the liquidity, you have the capital to be able to do this strategically, then there's going to be an awful lot of opportunity there. And also, if we do surprise to the downside in terms of rate cuts, rates are very, very high levels right now. Then, and we don't have a lot of gains in the investment book. We have the opposite right now. Mm-hmm. So to create that opportunity to be able to reprice that book, as Derek showed in that wave chart, where the more we can put 5.5 assets on, where historically we've been 2 to 3%, then that has long-term future balance sheet benefits. So that brings us to the end here. We appreciate your time here. This is always one of our most favorite things to do, to take this walk down the markets and the economy, and what's happening on balance sheet. So as I mentioned, please reach out. We have plenty of tools and resources where we can go through all the different things that we've shown you here, and always happy and willing to have a discussion. So thank you again. Thank you very much, and have a great rest of your day.